ECB, everybody. Hi, AJ. Hi, Richard. AJ beat you again today. Shalom. How are you, Sinatra?
Dale, good early morning.
Good early morning to you. How you doing, Kman?
Yeah, not too bad, thanks.
Good. So,
ECB.
yep, ECB, what are your expectations?
Well, they didn't change anything so far, but we've learned from prior press conferences that there may be a change of tone during the press conference compared to the statement.
Look at this candle. So, dollar strengthening, yeah.
Mrs. Lagarde, I don't know in what form she will be present because she contracted COVID last week, apparently, so she might not be even present in person during the presser, which wouldn't be a bad thing because usually she puts us asleep after 5 minutes of press conference by talking so slowly. So with the windows, it may be a very short press conference.
Did you find it interesting that the dollar actually put in a decent reversal day yesterday? Did it mean anything to you, or you think it was just book squaring ahead of the ECB?
And the yields coming off as well.
Yeah.
And for the euro, partially book squaring ahead of the ECB. Again, the main level around 108 and a quarter euro dollar is really crucial. So people didn't really want to be short into the level and into the ECB.
Yeah, it held it. I was surprised that this low here came in.
Yeah,
it was 808, and this low was 806. I would have been more bullish if they had already taken out the stops here.
Yeah,
maybe they still need to do that.
We of course can't rule out some barrier defense down there as well, which may come in the mix, but we are ahead of the Easter weekend with less liquidity. Yes. So if the press conference comes out dovish, let's put it that way, compared to expectations, I wouldn't rule out a test or even taking the stops out of 108, and then we reassess walking in next week again, you know?
Yeah.
But overall, if you look at the ECB not hinting at anything, they may have not changed anything to the rates, but leaving the asset purchasing program to close earlier, that might have been taken as the market as okay, maybe there's a change ongoing at the ECB, but now they're keeping the asset purchase program the same amounts.
Yeah.
So I reckon we should be looking back at what's weighing on the on Europe's shoulders right now, and them being very much behind the other central banks. We had our RBNZ, we had Bank of Canada, both raising 50 BPs. Bank of Canada being the first one of the G7 central banks raising 50 BPs. So they are way behind all the other central banks. So no matter how we turn it, interest rates will show a differential, which is going to continue to weigh on the euro. I see Mike saying, "What if she says APP ends in June?" But for the time being, in the statement it says that they will still be buying in May, June. The amounts were still the same. So for the time being, they have not changed the wording.
Yeah, hey, Kman, good morning, and thanks for the
morning.
Good morning. Thanks for the breakdown here. And I'm going to ask you, are you surprised at how dovish this statement reads?
In the reading of it, I must say I'm a little bit surprised. They talk about flexibility, but they don't show the flexibility in the statement, right?
Yeah.
So
yeah, Glenn Flower didn't think they would tighten yesterday.
Come again?
Danny didn't think that they would tighten.
Well, no one thought they were going to tighten today.
No, but they are not going to tighten, but they could at least have left some wording out.
Right. They could have given us the option that, hey, at the end of 2022, we're going to see some, more aggressive action from the ECB. Nothing today. Not even.
And let's not forget that if there is nothing spectacular happening in between meetings, the next meeting is only on the 9th of June. It's like a full 2 months away, right?
Yeah.
So I think the press conference will be very interesting, though. We can't rule out anything so far.
When
I'm
does that
sorry,
start, Kay?
you Europeans, man, you guys are screwed. Good luck with inflation over there. Sorry. Just because nobody's got your back. I'm sorry, man. Holy cow. I mean, I guess
in 25 minutes.
Yeah. The press conference is in 25 minutes, and it's going to be an interesting one. So let me ask you this, your opinion, and Stelius, I'm sure, is listening in right now. I'd love to hear his opinion too. Hey, what do you guys think? I mean, is this the right action for the ECB? I mean, should they? I know growth is it's fractured, I guess, is a good way to look at it. But the ECB is a really interesting animal as a whole, because you're trying to deal with so many different countries. It's not like like in the United States it's easy. Like, even though California, GDP of California is much different than Kentucky in the United States, it's still the umbrella of the United States of America, united. ECB is obviously a bunch of independent countries trying to come together to have one unified front, but it's difficult, right? I mean, so obviously you guys in Greece, Stelios, are dealing with a much different economic environment than those folks in Germany. So what do you think the ECB should be doing right now? Fighting this inflation, or dealing with slower growth?
First of all, I think inflation is high everywhere in Europe. So I don't understand why, obviously there's these diverse countries unified under one currency. In that respect, it's actually similar to the US, because you have surplus states, you have deficit states, but you have one common thing. You all have the common history, common language, common everything. It's much easier to have a union like that. The European Union was a very difficult animal from the beginning, and
I hear what you're saying, but if you live in Louisiana, you definitely do not speak the same language I do. I mean, sorry.
To answer your question,
I had to go there. I had to go there. Sorry.
To answer your question,
go ahead. Sorry,
inflation is high everywhere. I am just amused by how the ECB does not do anything, and you said the right thing. You got it spot on when you wrote in the chat room. They're talking about COVID, for Christ's sake. We're going to restart PEP if COVID persists. COVID is pretty much over. You have to get over that. But anyway, they are very dovish still. It amazes me. And I would have been a lot more hawkish. I would have already tightened. Because this is your window. This is what the Fed is doing so well. This is the window of opportunity. They have to do something now, because then in a year's time, they're going to be in recession. So they have to do something. I don't know. I don't know what the other guys think, but I'm just amazed.
Yeah, I'm amazed too. Kman, do you think that right now that ahead of this press conference, Christine Lagarde is like having this like serious conversation with other, ECB members about like how she's got to approach this meeting? I mean, what kind of conversations is she having right now on the phone, on FaceTime with other ECB members? What are your thoughts?
It's a really open question, because she's done it already on a past meeting to come over differently than on the statement. Really, it's an open question. If she just repeats the statement and says, "See you in June," then
you're selling euros
over dovish, right?
Yeah. If she says that, I'm cutting my euro pound loan, which is very small, but I'm going to cut it.
But the thing is, which I always like to stress, she's a lawyer. She will not tell us, "See you in June." She's a lawyer. She will talk until we fall asleep, and then try to make us forget what she even says. But and don't forget that last time when she came over hawkish compared to the statement, euro flew up, and then the next day she went the other way around, right?
Yeah.
And so,
but that was every central bank was doing that.
And I think
every central bank
try to walk the same tightrope as Jay Powell is doing, but with I don't know, a 1 or 2% delay on the Fed in interest rates. Let's put it that way. So it's a real open question. I just replied to Mike on the chat. It's really an open question to me.
Yeah. Okay. Well, you know, that's a great point that you bring out. And I want to emphasize what Kman just said. And it's something that every central bank head has been doing. Well, not everyone, but Jay Powell's been doing it. And it's something that you, if you think about, in the Bank of England did it as well. You know, what is said in the statement is also different posturing that you get in the press conference. And they do this. It's kind of like it's a fine line. You say one thing, you print another. It confuses the market a little bit, but it keeps the market from getting too one way, right? Like if she came out and was like super, like let's say the press conference was super hawkish. Let's just say, super hawkish, and then she comes out and just reiterates what she said, and then the euro, is trading 2 big figures higher. Come right out the gate. Here we are this morning, and we're like, 200 pips higher than where we're currently at right now. That imbalance is it's not something that banks have to. It is something they have to deal with, and it's not the momentum she necessarily wants right now, because you want to maintain, a weak currency, weak enough to deal with slower growth, but you don't want it so weak that inflation gets sparked even further. So, I think you bring up a great point, Kman. She may be, playing the game, just the Jay Powell game.
Yeah,
so,
right. I mean, the currency, the currency argument. I haven't got a clue why they would be worried about a euro 2, 3, even 5 big figures higher. It's actually, I know it's a small percentage of inflation, but a strong currency is, after all, giving people cheaper import prices, right? And a strong currency, a basically strong currency. Look at what we have been trading Deutsche Mark before. A strong currency, despite low interest, gives a lot of confidence, and investors want confidence. But the longer that she or the ECB are going to uphold this uncertainty, and we're only following in the distance, we don't know what we are going to do, it's going to weigh on the euro together with the rest of the other things. That is my personal view, of course.
Yeah, no, I hear exactly what you're saying. Well, and hey, for those of you guys that are trading the euro right now, what I'd be looking for is really above 109.25. That's when things start to loosen up to the upside. We're not too far away from there. I mean, as dovish as the statement read, I mean, we really are only about, let's just call it 20 pips lower than where we were, an hour ago. So it's not like the euro is extremely weak right now. No. And, we have held the 108 level pretty well. Obviously, if we get below 108, things are going to get kind of, squirrely for anybody who's long the euro bottom line. So I would be carefully watching the euro going into today. And this is kind of like the little trend line that I'm watching. Really, we need to get over 109.50, but 109.25 will be the first release valve, if you will, for euro bears. All right. Anything else on? Yeah, go ahead.
Can I please just add any, because I'm going to need to prepare the publications of other data, because we got retail sales and initial jobless claims coming up as well.
Yeah, I
just want to warn people, a word of caution: be careful with your positioning, because from tonight, a lot of this market is going to go into Easter weekend. So watch out for your spreads on the retail trading side, okay? Because some of the liquidity providers may start to go defensive, and it's always great to have nice positions running, but you have to be able to get out of them as well. So just a word of caution.
Great point. And let's also mention that, liquidity is, as Kman pointed out, liquidity is going to be pretty poor. Everybody's off for a long weekend. That means that if you happen to have, like, let's say you're long or short a currency pair, and orders still will go through between today and tomorrow. So the FX market is open, liquidity is poor, so things can move aggressively, especially if there's some headlines some headlines hit over the weekend. So, Kman, we'll see you in the chat room in just a little bit. And for those of you that don't know, that's the one and only Kman, and he's really in our chat room he's in our chat room all day long now. And he came with Ryan from Forex Flow Live. You can see all the chatting that we do here. That's just today, and you can see there's Kman right there in his commentary in green. And so that's just our chat rooms that you'll see here, and we're all always in there, chatting away, talking about positions, talking about what we're doing in the markets. So, Stelios, what else should we be looking out for today? I mean, I don't know if I want to chase equity markets at this point in time. We had a nice little kind of pullback here and a bounce back towards channel resistance. But do you think we start getting long equities because we have the ECB is still seeming pretty loosey goosey, or what do you think here?
Don't know really. I mean, with yields kind of going a little bit lower, I think that's a correction. I think yields will continue going higher.
You think yields are going to continue higher, huh?
Yeah, maybe not today, but I'm
okay.
just saying.
Well, that's pretty. Let me pull up the 10-year. Here's my skepticism, and I'll just show you, and then we can talk about it. Here is the 10-year bond market, and you've got, the bond market looks like we're firming up. So if we firm up, come out of this wedge, we hit an 88% retracement over the last, I don't know how many years that is. That's from 2018 to today. An ascending wedge. We're breaking higher out of that wedge, which means yields are coming down. But you don't think that this is going to sustain, do you?
No, yields are coming down for the last 2 or 3 sessions, but
Right.
We're seeing inflation higher everywhere, PPI, CPI, any kind of measure. So yes, the ECB has been so far dovish. Let's wait for the pressure, but
Right.
It is unavoidable, in my opinion, obviously my humble opinion, that rates have to go higher, that they have to be tightening. They have to. It's their mandate. Yes, they can go around and try to confuse us, but they have to do that. So I think as long as the situation is as it is, and I don't see that reversing anytime soon, we're going higher in yields, and that's going to bring pressure to stocks. But for the last couple of days, yields are going down. So I think over the holidays that are coming now, maybe early next week, yes, stocks could rally a little bit, but I think we sell the rally. That's what I think. Well, this is always in the short term. In the long run, I'm talking about years ahead. That every index is going higher. That's unavoidable. But in the short run, and as I said before, the Fed will keep tightening as long as stocks stay bid. They will do as much as they can. They'll do 50 next meeting, 50 the meeting after. When the S&P reaches something like 3,600, 3,700, then they're going to probably stop. But until then, this is their chance. I mean, I'm not deviating from this view, which is my, it's a more long-term view. It's not what's going to happen today or the next week. And I think that's my view. I could be wrong. That's my view.
All right, very good. So we got retail sales coming up, and let's take a look at the dollar index. We got retail sales coming up, and is the consumer going to be influenced at all by this surge that we've seen in inflationary data? I mean, we've got this. Obviously, U.S. consumers. I mean, it's hard to bet against the U.S. consumer. I always tell people that, just like, they're going to spend money. They're going to find a way to spend money, no matter what, on stuff that's completely has nothing to do with anything but them being on Instagram. But what do you think here? I think, is that Steve's voice that I hear?
That is Steve's voice. Blake,
hey, Steve, what do you think about
today's expectation for retail sales are for a 0.6% up month on month. I remind you that this is the same month that inflation was up 1.2% higher. So basically, since retail sales, as I've said, probably something like 100 times before, are not adjusted for inflation, that means that the expectations is that this month, the month that passed, if the number proves to be as expected, actually consumers, ended up buying less products than they did last month, right? They paid a little bit more than they paid last month to get less items than they got last month.
Yeah.
So,
I felt that at the grocery store. I think every package was like a half of its size.
Exactly.
And they still paid the same amount of money.
What does the combination of people spending, and that's purely by numbers, it's not speculation. What does the combination of the following three things tells you? People keep spending more every month. They keep buying less because inflation is outpacing the growth in retail sales, and credit card debt is skyrocketing, right? Shooting higher at an unbelievable pace. What does the combination of these three things tell you?
Oh, buy Visa.
Yeah.
Just kidding. It tells us that the consumer is really stretched here. They're reaching for pockets of liquidity, right, to pay for things. I mean, look, if my bank account is like getting dwindled and I'm like, oh man, but I got to still put food on the table, I'm going to start tapping my credit card, right?
Yep.
Yeah, and that's scary. All right, so
it is.
So retail sales, and right now, just so you know, now everybody's really talking about inflation because of obviously the CPI print that came out, the year-over-year print that we saw this week. So that next month is really going to see an effect, but we're starting to see the cracks, and so let's watch the dollar. Just technically, guys, I'm going to just point this out, and this is something. If you missed, like I did the trade off with Chris Weston. He was actually in the Outback last night, and we were still doing the show. But I was talking about the dollar as my favorite setup for a reversal, guys, and just the reason why. A couple reasons. The first one is channel resistance, false breakout, 161% extension. We hit it. This is the range that we were in, 161% extension. Hit it, reversed. This is actually a dark cloud cover. If we get a black candle today or a bearish red candle, we call it black. I get in the habit of saying white or black because that's the way we reference them in ForexAnalytix.
That's just racist, man. Seriously.
I could have said feta and soy sauce. We got feta candles and then soy sauce candles I'm Chinese and they are Greek. But anyway, black and white, just because that's how we reference them, charts previous to having color. But anyway, if we had a red candle, which would be a bearish candle today, that would be dark cloud cover. We break through 99.40. That's going to be a false breakout to the upside. It's a lot's got to happen with the ECB today. The ECB presser has to be pretty hawkish in order for the euro to break out and the dollar to break down. But that's something that we should be watching post retail sales number and obviously press conference today. And let's see if the confidence in the euro bulls euro bears gets shaken following the ECB press conference. So it's going to be an interesting retail sales number. Stelios, you have anything you want to add to that?
Not really. I think Steve said it all.
Okay, very good. Hey, I see Grega just popped in here. Grega, good morning and or good afternoon, depending on where you're at. Or I don't even what time is it where you live?
Currently, it's 2 p.m.
2:25.
Good afternoon, guys. It's still 5 a.m. here. So, and for Dale as well. So let me ask you. You have any thoughts on the euro going into the press conference and into the long weekend?
I see a very nice potential wedge formation on the euro dollar. So if you connect, since you have it here from December, from December lows of last year, the previous low.
Right here?
No. 2021.
December of last year. Oh, December of last year. Got it. Okay, so we're looking about somewhere right here?
No.
Right there?
Yeah, exactly.
Okay.
And connect this to the lows, and then you have the upper high of 2022. Exactly. So this is what I'm looking at. So I think that we could be approaching these potential supports in the near future. As you know, we've been looking for 108 to be potential revisited, and since we are here, and we also discussed with Kman, I think a week or 2 weeks back, that this would be quite interesting zone if maybe ECB will change its rhetoric based on technical perspective and timing. I think it's very attractive for potential surprise here in the upcoming weeks for rally on euro. Of course, we could be printing a little bit lower prices, but I think that technically we are at very strong supports.
Yeah, it is definitely strong support. I'm trading against it, and I know everybody else is. I mean, I'm not the only person right now that's looking at this and looking at these longer term trend lines in here that are trying to trade against them. So that means there's probably a lot of stops below 108, myself included. So, and that's something that we have to think about positioning as we go into this. But really strong support if you take those lows from back in 2016, lows in 2020, post-COVID spike lows to where we're at right now. It all comes in right around.
And also we have to keep in mind that there is a holiday reversal patterns. Usually when you see, let's say, a strong drop on euro towards the holidays, and then few sessions before the holidays, this trend may actually change a little bit because of portfolio adjustments, and I would not be surprised if that would be the case. So even if euro dollar is not going to see any strong bullish move, it could continue consolidating.
So is that the Easter Bunny reversal, or he has risen reversal? Sorry. That was a shout out to you Orthodox folks. All right. Which Steve is Greek Orthodox all the way to the max.
All the way
to the max.
Fanatic Christian, yes.
Yes. Whenever I'm not in a webinar, I'm in the church.
Right. It's funny. Just so you guys know, and I can laugh about this. My wife and we got married in Greece, and I am Greek Orthodox. I was actually baptized Greek Orthodox so I could physically be married in Greece back in 2003. And I think I might be more Greek Orthodox than Steve is. And
100%. I can guarantee you that.
Anyway, it's so it's a long time joke for those of you that haven't listened in to us for years. We're just a few minutes away from the retail sales data. Any last minute ideas? I just want to say the dollar Canadian. Wow, what a reversal yesterday. I'm sure if you were bullish, you're like, wow, what, that was a big rejection of the underside of this, previous wedge. You can see that dotted line. We came up to it, previous support, rejected it pretty hard yesterday as the Bank of Canada is raising rates. Obviously, out in New Zealand, the RBNZ raised rates, and we got a big reversal there. We're still consolidating below that trend line, and it looks like Mish is showing up. Good morning, Mish. How are you?
Good morning.
You look fabulous. First thing in the morning, it puts the rest of us to shame, especially me. So I will not even turn on my camera this morning. Dale is going to be with you in just one moment. We're just going to cover retail sales as they're coming out, but it's great to see your face.
Nice to see you. Nice to hear your voice.
Nice to hear my voice, right? All right, good. We'll see you in a few minutes. All right, so guys, any last minute ideas, thoughts before we go into retail sales here? I am going to be watching. Let's just pull up dollar yen. You notice how we're probing. This is a pretty big intraday trend line here, and we're kind of right on it going into retail sales. But any thoughts?
Really, I just wanted to say that inflation data is much more important, unfortunately, at the moment. So yes, big number today, but in retail sales, but I wouldn't give it too much weight.
I agree with that.
Yeah, I don't want to be spoil the numbers and everything, but it's really inflation everybody's looking at.
Right. I mean, even if it was jobs data, I wouldn't really care that that much. As you guys know, the NFP is not a market mover at the moment. CPI and PPI this week were definitely the hot data to be looking at, and continues to be that way as long as it's on everybody's radar going into midterms this year in the United States. So here we are about a minute away. Let me pull up the data flash.
I wasn't here for the PPI data. But let me state the obvious, right? Whoever, because I read a lot of BS about people calling peak inflation. I have no idea how somebody can even attempt to call peak inflation when PPI is increasing and is heavily north of 10%.
Oh, by the way, we got the
well, you
numbers.
can. That's J.P. Morgan and Goldman. They, I mean, what
I
I
mean,
don't know what they're
PPI
saying.
is a leading indicator, right? It's like textbook leading indicator.
What your producers are how they're feeling. You think
Yeah.
they're going to pass it on to the consumers? Of course.
Of course, they have no alternative. They've already squeezed any
All right.
margin they had to
Hey
meet up
guys, just
inflation.
heads up here. So we got retail sales better than expected, not moving the market at all. Some Canadian data came out. Oh wait, no, I'm sorry. I was looking at the core retail sales data came in actually a little worse than expected. The core retail sales is a little hot, and we're not seeing much of a move. So, we're going to be waiting on the ECB because the press conference is starting right now with Christine Lagarde. But I would rather listen to Michelle Snyder over Christine Lagarde any day of the week, and she happens to be with us today. So, Dale, I'm going to pass it over to you. Have a great Easter weekend, everybody. Make sure you guys stick around for Michelle Snyder. Stelios, Steve, Kman, and then also Grega, thanks for joining us today on the F.A.C.E webinar. You guys have a great long weekend. Dale, it's all yours.
Thank you all. Bye-bye.
Thanks, Blake. Thanks, team. Michelle, welcome back. Great to see you.
Nice to see you guys.
So, lots happened since you and I last talked. A war, some NASDAQ stocks really taken to the woodshed. Everyone, holding up Kathy Wood as the poster child of this correction. I'm curious with what's been going on here. I've never seen people more bullish about commodities since the 70s, Michelle, and you were very bullish early on the last few years before it was fashionable to be an inflationista. So
Right.
I'm thinking,
I'm
could
either
there
the
be
broken clock who finally
could there
got
be-
right, or such a genius that I was ahead of the curve.
no, because you're a great technician, and you and Keith work hard and study the markets, and you have for decades, and you learn. Experience can't be really, you have to live and go through different market cycles, and I think you and I have seen a couple. Does it feel like the market's a little bit on one side of the ship right here? I'd say the most hated position would be debt, any kind of bond down here, and everyone loves oil and gold.
Well, definitely there's reasons. I mean, it's one thing if it was just a crowded space of gold and oil and food, which is really the thing that I've been talking about for the last couple of years was going to drive this inflation. And even though oil has been the major focus in the media, as it should be because of the Russia-Ukraine situation, historically, if you go back into the 70s, oil was the one that went up first during the oil embargo.
Right.
And it took about a year later for everything to start catching up. And now we have the oil up and everything up at the same time. So the relationships are going to be a little bit different. I still think that oil, I mean, I've heard people who I really admire and respect say they think oil is going to $250 to $300 a barrel. I don't know if that's going to happen. What I do know is that we're not going to see much downside here. I don't see any fundamental reason why there's going to be a big outpouring of oil on the market to be able to satisfy the lack of supply we've been not able to get out of Russia.
Could demand destruction out of China, Michelle, with them locking down the whole country? Let's face it, they're the consumer of everything.
Exactly, but they're going to come back. That's the thing is they're going to come back. They're not going to stay locked down for forever, and they're locked down, and these people don't have anything to eat. I mean, from what I've heard. So, and the shelves are empty. And yes, that's another big area, but I'm sure that, well, we can see that she has been buying oil from Russia and will continue to buy oil from Russia, whether they're right now have bigger demand because people are locked up. It's only 26 million people. And it says only 26 million. In this country, that's a percentage. In China, it's nothing. You have 1.3 billion people. So it's still relatively small comparative to their population. I think but whatever we have in terms of a setback as far as demand in China is only going to then catapult more forward when Shanghai opens up again. So, and there's a couple of other little towns in there. But, you know, let's put the oil on the side. Oil is not going down anytime soon. How far it goes up remains to be seen. But I'm still more focused on the impact on food, even more than anything else, industrial metals or miners or anything like that.
Because they're not economically sensitive, and there's nothing, higher rates that may cause demand destruction is not going to want to put people on diets.
Exactly, because the one thing that we absolutely must do is eat. And the problem with the food I don't see any relief in sight. I mean, we have a USDA report, I think, coming out next week. I'm not 100% sure on that. But what we do know is Ukraine, big exporter of food, even if the war ended like next week, and of course we all hope that happens, it's still going to take a long time for them to be able to come back to capacity. Here in the United States, if we have any kind of drought, which already is prediction for drought, or floods, which we just had, believe it or not, I just read in South Africa, they had these tremendous floods that destroyed a whole bunch of stuff and really almost stopped any kind of port in terms of goods going in and out. There just seems to be, like, at this point now, the threat to the food supply versus the demand is one thing. Now let's take it a step further. What happens when people don't get enough food? We're already seeing it. There's been protests in Peru. Right. There's been talk of social unrest in China. I don't get too worried about that because China squashes anything that gets out of control pretty quickly. But there has been in other areas in Africa as well. There's been
Middle East had a problem last time there was a wheat shortage, and you know, this.
Well, the Arab Spring emerged from food issues. So, and in this country, we're still relatively tame. And what's so interesting about this country is, after so many years of complacency, that I think has been somewhat intentional from many places, but let's say corporate at this point, to keep people fat and happy and sedated and into their toys and watching TV and, you know, thinking that they have to look a certain way and feel a certain way and be a certain way. People don't even really seem to be, complaining. I hear people complaining about the food prices all the time, you know, myself included. But nobody's really at the point of social unrest here. So if we get to that point, that'll be interesting. So, these are the kinds of things that I think about, which is why we've been telling everybody to buy the softs and the food commodities. DBA, we've been in forever. We added to that position. And regardless of what happens.
Let's see your pantry. Let's see your pantry, Michelle. I want to see, I know that you're prepared. And you've got lots of peanut butter.
I'm a vegan, so, as long as I can grow something, I can eat it.
Do you have a victory garden like the 30s? Everything's coming back.
No, actually, I'm very ill prepared. I think most people are, I have a couple of friends who are like, survivalists, but they're nut jobs, but maybe they won't be so nutty.
You never saw yourself walking around in a Mad Max environment, did you?
No, I'm on the ilk that if we got to that point, I've lived a long life. You guys handle it. I'm out of here.
I hear you, Michelle. And you know what else exacerbates the whole grain situation is the cost of fertilizer. So, I mean, the input cost for farmers makes it almost, and in many cases, not worth planting, even with these kind of prices. Right. So, it's all coming together in a perfect storm. I do think the Fed could have impact on industrial commodities like copper,
Yes.
oil, lumber. I think that's what they're going after anyway, is that they want to slow down the speculation in financial markets, stocks and real estate. Is that your read on them?
Well, I don't know if they really know what they want to do. I think right now that's been another really big issue is, so, we've talked about the commodities, and that's why I think I said, no matter what I hear about it peaking and all this other stuff, I take that with a grain of salt because I don't think they're thinking about food.
Yeah.
Especially since, PCE doesn't even count food as part of the equation. I think they're thinking about things like used cars and stuff that you're right, that once things get too expensive, and now you mentioned housing at some point, but even the housing is in a unique situation right now because there's a shortage of housing still.
They can't find windows to finish off the houses, I'm hearing.
Which has now also even created more of a housing shortage. So people who want to buy homes are paying up because there isn't much homes out there, or aren't much homes out there. And on top of that, even with the mortgage rates going up, they're going, okay, well, 5%, but it could be 8% in a year, so I better buy it now. And so right now, we still haven't had a switch on that. So the housing market is interesting because, getting back to the Fed, what's really happening here is that these calls for recession, this recession is not going to be a typical recession because of the housing market is not going to collapse at this point. I mean, could it? Yeah, sure. But I don't think the Fed is going to goose up the rates nearly as much as they would have to get that to that point. Two is we have a labor market where we still have so many people who haven't even gone back to work, with about 11 million jobs still needing to be filled.
What are they doing, Michelle?
They're trading. They're trading.
You really still believe that? I mean, Robinhood is taking the hit. You think
Forget
that they...
about Robinhood. They're trading. I just came from a conference in Real Vision Conference. I was one of the speakers, which was such a great honor to be the woman representative in the trading world. And how unusual for me, right? And so while I was there, I got to see a lot of people, talk to a lot of people who attended the conference. And I can't tell you how many people are quitting major careers to become full-time traders. Partly because they think they can trade cryptocurrency, and partly because they think that the equity market they're going to make more money. And now with it being commission-free,
right,
they don't have to worry about that. And so that's why at least these people came to a conference to try to figure out how to do it. But there's a whole lot of people who just think that they can do it. And so to me, the equity market is much more vulnerable than the commodities market, not just for all the reasons we just stated. Even the ratio between commodities and equities, even though it was at a 100-year low just 2 years ago, has come in, but it's still nowhere near where it could be. And now you have all these speculators who have come into the market, who will continue to come in the market, buy these dips, and then realize that, we're in a trading range. We're not going to new highs. That's not happening anytime soon. We're going into stagflation. But anyway, let's get back to the Fed. So you have the labor, you have the housing, and then you also have this disconnect, as we started to say, about the U.S. consumer that is just so tired of being home and not doing anything after COVID, that they're out buying stuff. They're out eating out in restaurants. They're complaining about the prices, but they're adding to their debt right now.
Yeah, they're using credit cards to buy groceries.
Exactly. So, which is something most people always did, except for during COVID. So now we're not going to really necessarily go into recession, but we're certainly not going to have any economic growth. So here we are. You and I, Dale, talked about stagflation for the last couple of years. It was inevitable, and here we are. So what do you do right now? What is the Fed going to do? The Fed certainly knows that from stagflation, you can go into recession, or you can go into hyperinflation, and we have a midterm election.
You could do both. Yeah.
Oh, yeah. I mean, so in some ways, I think they'll do some of it down into recessionary areas. And in some ways, they have no control. We'll see the hyperinflation. And so this is an environment where you have to be a super creative trader, because this is going to be unlike anything that anybody has ever seen in terms of fitting into a box: recession box, inflation box, stagflation box, goosing up rates box. All of these boxes now are so
Unprecedented.
Yeah, exactly.
Has your family broken up, or are they still together? You know who I'm talking about, those guys. You know the family that you would always present.
You're talking about my modern family?
Yeah, your modern family. What, are they fighting with each other right now?
Yes. Well, no, yes and no, not really. They were for a while, where you had semiconductors still doing really well.
Yeah.
You had transportation holding up, but yet retail and the Russell 2000
Yeah.
and then even the regional banks were doing well for a while, but now they're all lower. The only thing that's actually reversing is biotechnology. And biotechnology makes sense, because in this environment where people are coming back from COVID, they're finally going to take care of things that they didn't take care of for 2 years, just normal health stuff. And so we're actually long, in terms of equities, we hardly have any equities on, but we do have biotechnology as one of the areas we're looking at.
It's pretty defensive. It's pretty defensive as well, isn't biotech? Would you call it that?
Well, it's a cyclical and it's a non-cyclical. And that's the advantage of my my biotechnology member of the family. But the rest of them, they're all in consolidation mode, hanging on to recent lows. And if they break these lows, I think we'll see another leg down. Do I think we'll see a vicious sell-off? No. And in terms of the interest rates right now, they've got so oversold. As if you just look at the TLTs, I wouldn't even be surprised to see a bounce, especially if the market goes lower.
DSI got to 5, Michelle, this week. It's a pretty low reading. 5.
That's a pretty low read. Yeah. So I wouldn't be shorting the bonds here. Let's put it that way.
What do you think about the dollar? Let's make history that the dollar is peaking up here on our interview, or maybe it did it in anticipation of our interview yesterday. Are you looking for the potential of a turn in the dollar, especially after we weaponize the SWIFT system and we're overdue for some type of dollar decline? And would the Fed welcome it?
Well, yes, it would make it easier for the Fed, for sure. And remember, one of the things that Donald Trump wanted was a weaker dollar, because a weaker dollar is good for a lot of things. But right now, here's the thing about the dollar. I bought F.A.C.E. because as soon as the dollar has gone par with F.A.C.E., which means, for people who don't know what that means that the dollar and the F.A.C.E. are at the same rate, right? So if you go to Europe right now, you're not getting any great advantage with your dollar, but at least you're not getting a big disadvantage like you had for so long. So what's happening right now is at par. If you look back since 2017, every time F.A.C.E. got to par with the dollar, F.A.C.E. had a big rally. But it had a really big V-bottom type rally. It wasn't like anything that you had to guess about. It went down straight and then went up straight. So right now, here we are. We're at par, basically, right now. I had bought the F.A.C.E. a little bit higher, and I got out because I wasn't sure. The dollar's been sort of this safety net play, which has made it portended to a point that I thought was a little bit silly, considering our inflation numbers.
Yeah.
So there's a lot of manipulation there. But I would certainly be keeping my eyes on it, if not today, because we have a long weekend and anything could happen. If things blow up more in the Russia-Ukraine, we could see another spike in the dollar. But if things stay relatively calm and we come into next week and we're still around this par and the dollar starts to droop here more, or can't get back over 100 if you're looking at DXY, I would buy the euro, and I would just be, okay, I'm wrong if it breaks par, and if it continues to go up. I heard before talk about 108. I think that would be a reasonable target, potentially.
Okay. And commodity currency, since you are a inflationista food bull, would you be looking for buy spots in commodity currencies like Aussie or the Canadian or New Zealand commodity producers? And Brazil, their ETF is doing well. They're a big producer of grain, oil. Is that where people should stay if they leave the US? Look at those markets.
Well, I think that the emerging markets that have been commodity-based countries have done very well and probably will continue to do well. Brazil, of course, is the classic example, but even South Africa has done well. Even Australia has done well. Canada is not an emerging market, but the Canada ETF has done very well. What's interesting about EEM is that half of it is China, which,
Yeah.
that's not doing so well, but and a lot of people are very negative in China. I think China has made policy-wise some mistakes, going after the tech the way they did.
Yeah.
I think hurt the country a little bit, and so that's what slowed their economic growth. But do I think they're done? No, I think they're busy trying to figure out how to work with Russia and India to have their own little access. I think this deglobalization we're into right now has some advantages and disadvantages to be aware of. But yeah, I would be looking at commodity producing countries. And in terms of the US, let's just focus on the US for now. I'm more on the bearish side than on the bullish side. But I won't go short here. But what I did do is I bought volatility, probably not the first time, because I've bought it a couple of times, but more actively traded. I started a position here. We'll see. I mean, I always have a stop. I don't like being wrong. And if I am going to be wrong, I like to get out quickly. But I started this position in VIX because, believe me, I know all the conversations about backwardation and blah, 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 and the relation to VIXX. I know all of that. And everybody told me the same thing 2 years ago when I started buying natural gas through UNG. Oh, you don't buy that, it's backwardation. Meanwhile, it was the best trade. And we just took another profit from it at over 24.30 yesterday.
Huge
so
move.
So I say don't listen to all that stuff. If you just look at VIX right now, VXX, the 50 is crossing the 200, which is the classic golden cross. The price is right on the moving averages. That is rare. That is rare. That's like a picture perfect opportunity to say, if I get into volatility right now, I'll know right away if I'm wrong. But man, if I'm right, that would be an add type of trade, because that could be the volatility that people keep talking about, but you're not seeing it.
No, you've had a 20 to 30 range.
Exactly.
That's your range. So you think we could get a breakout over 30, that would measure 40, 50, something, a pretty nice move.
I think it's extremely possible. And once again, I feel like I'm one of the very few voices talking about this right now. I can only gather that from what I see on Twitter, and then the pushback that I get on Twitter when I say stuff like this, just like the pushback I got on natural gas 2 years ago turned out to be 100% correct. And now I'm seeing this with volatility. If you look at implied volatility versus the discount, it's out of whack here.
You're like Jeremy Grantham, female Jeremy Grantham, the super bear. I wanted to ask you something. Do you think, I know you think about these things, Michelle, and the press is really underplaying it. There was a partial default by Russia. There was another default in Indonesia this week. And it seems like we're moving into, a place where there's going to be solvency issues. Some people are saying we're in a sovereign debt crisis. Do you think that if there's a Russian default, because we were in the business during the last one, that it's going to be a big deal for the market, even though we're generating it for them by freezing their assets, and we'll have to bail out the IMF and the World Bank, because that's basically us too, from the default. Have you thought about that at all?
Yeah, I certainly have seen the headlines come across about the defaults, and certainly about our own ballooning debt. And I know people are very concerned about it. I would say right now, it's already in the market. When I say it's in the market, that's not it's priced in and it won't have another impact. What I'm saying is, I think the reason why we're floundering down here, but yet holding, is that same sort of disconnect of the reality versus the fact that people still have this idea. I mean, I hear this all the time, that if Russia goes into a default and the market goes down, the Fed's going to come back in, forget about raising rates, is going to come back in with more accommodative policy, and therefore don't worry about it. That's, I think, the most dangerous thing is kind of what you said, which is it's out there in the news, it's kind of being ignored, it definitely can have a domino effect. In some ways, it's already there in the market. We're seeing it, which is why we're more on the lows.
Yeah, JP Morgan took a counterparty risk hit just the other day. So there's tentacles on these Russian liabilities to counterparty risk all through the globe. It's a global banking system. So
absolutely, and that's why you're seeing this move to deglobalization. But that's the negative of the deglobalization here. I mean, in this conference, I listened to this guy. I can't remember his full name, so I'm not even going to say it. But he's one of the top geopolitical. Yeah, and it's guys like, you know, big deal. When I was listening to him, I was thinking, my God, you know, I don't have any kind of knowledge like he has. And yet I came to the same conclusions because I can look at charts. Yeah. But nonetheless, one of the things that he said was that the US is actually in really good shape for a deglobalization because we have natural resources here, so we could take care of people. We are bordered by 2 oceans, so we're basically impenetrable. And we have the strongest military in the world, which means nobody's going to attack us, or if they do, it would be to very serious consequences. And that's been playing in my brain over and over and over again, because a lot of people would love to see us completely back into an isolationist country. But then on the other hand, you have to say, well, we've gotten so used to cheap goods from China in this country. Yeah. Are we really willing to pay up to be an isolationist country after years and years and years, decades of being spoiled? I mean, I was cracking up. I was on Cavuto this week, early in the week. I came back from this trip and I took thanks to Biden, one of those home COVID tests. Oh. And I was looking at the box and I'm like, it's made in China. Yeah. I was like, wow, that's really crazy.
Yeah. So you go ahead.
I know these are heady. These has nothing to do with what do we do in the market right now. But you're asking me if I think about these things. I think about these things constantly because we're into this huge game of chess right now. So I'm trying to be like 4 steps ahead so I can position myself well in the market, or at least, and my clients, at least be somewhat prepared if I'm wrong and everything just goes to the moon, like some people think. Yeah. Or I'm right and commodities stay very strong and equities fall apart and volatility goes crazy.
You know, an ex-girlfriend of mine told me that women are always 5 steps ahead of men. They had 5 moves ahead. Anyway, so do you think it would be more appropriate, instead of calling this a supply chain disruption, to call it a supply chain destruction, and that it's going to take years for us to begin to rebuild made in America, and it is going to be more expensive, but it's not going to happen overnight. Just in time is out of time, and this is going to be a long-term process.
That is such a great question because it totally just plays into everything we just talked about. So let's take that isolationist policy, because the good news is after we go through this period of complete disruption or destruction, as you say, in history, going way back, comes a period of innovation after that, which of course innovation also always leads back to complacency because, hey, everything's going well, we can relax. But if we're going to go into an innovation and this scenario plays out and we do actually get back to made in America and we become less dependent on importing goods from foreign countries like Vietnam or China that make them cheaper, then we could actually have some kind of economic boom in this country. But like you said, It's years out, which is right now we are in, that's why I keep using the word stagflation. We're stagnating. We're not
Yeah.
seeing any growth. We haven't seen growth in this country, except for in the technology space, which is legitimate. But in terms of infrastructure, industrial, manufacturing, all of that, we've seen almost zero growth in that area. And I don't think we're going to start growing out of it right now because we've got so many other problems, inflation being the top one, and food especially. Then yeah, let's look out. Maybe in 5 years from now, we're in a situation where we can really see our way to America becomes completely independent and not interdependent. And that would be our next great big move up. That's a very roseate, optimistic viewpoint, but anything's possible.
Hey, you know what? I want to leave it with that thought that America is going to come through whatever we have to go through. And in 4 or 5 years, we're standing on our own 2 feet and proud of when we go into stores that everything that's being made here, a majority, and we've come through the debt and the inflation, and happy days are here again. And we build this time on a rock instead of sand of debt. And Michelle, I want to wish you, happy Passover. I know we have a wheat shortage, so we're going to people are going to have to get used to unleavened bread, I think. So really great being with you and hearing you. What a great time I just had.
Oh, thank you, Dale, and thank you, everybody. And yes, happy Easter, happy Passover. Yes. Have a great long weekend, and I'll see you again soon.
Okay, Michelle Snyder, and you could find her on Twitter at Market Minute. And the name of your website again, Michelle?
Marketgauge.com.
Yeah, go there, check it out. Minimum follow her. So that's a wrap, everyone. Have a great weekend. Remember, don't just count your pips, count your blessings. We'll see you next week. Recharge your battery and get your plan ready when the markets are closed. Good luck on the ECB. Thank you, Michelle.
Thank you, Dale.
Bye-bye.
Bye.